Optimism about the scale and the timing of interest rate cuts in the major economies, well, it's declined consistently in recent months. The year began with markets pricing in cuts of 60 basis points or so in the US, the UK and the Eurozone. Today, those numbers are much smaller, just 6, 12 and 22 basis points respectively. So, what is the outlook for interest rates now that markets have got so pessimistic? Let's start with the US, where the shift in interest rate expectations has been greatest. That move to pessimism reflects data which suggests that inflation is no longer falling, remaining above target. Now, as we've discussed in recent podcasts, a lot of this reflects inflation in rents, or shelter as they call it, which is stuck at close to 6%. Now, the effect of this is magnified there by the absurdly high weight placed on shelter in the US Consumer Price Index. That weight is 36%, far higher than in other countries. Now, the weight on actual rents paid is about 8%, and that's no different from most countries. But the US add in something called owner's equivalent rent. That's what homeowners would pay if they rented their house from themselves. Sounds crazy? Well, I agree. Exclude shelter, and US consumer price inflation has been at or around 2% for the last 12 months or so. And if rental inflation were to remain at 6%, the rest of the CPI would have to show zero inflation to get the total down to 2%. Now, the Federal Reserve actually targets something called the Personal Consumers Expenditure Deflator. That has a lower weight on shelter, but at 18%, it's still too high. The problem remains. So where are we left? Well, the Fed certainly won't be adjusting their targets to downgrade shelter anytime soon. However, there is cause for optimism. Ultimately, rents and the cost of other services, they're determined by wages, with a bit knocked off for productivity, and wage inflation is falling. There are many different measures of wages in the US, but there's a consistent pattern of improvement. The gold standard, everyone agrees, including the Federal Reserve, comes out quarterly. That's the Employment Cost Index. And that series has been slowing since it peaked at a little over 5% year on year last June. And I expect it to show a 3 handle when the next number is released at the end of this month. It's a close call, but I expect this will mean US goes ahead and cuts rates by 0.25% in June. Over in Europe, we can be more confident of a 0.25% cut in June, not just because the fundamentals justify it, but because members of the European Central Bank have told us that they will cut, or they've come as close as any central bankers ever do to promising a rate move. It's a bit cloudier here in the UK, but the growing consensus that our inflation rate is about to hit the 2% target and stay there for the next 12 months means that the Bank of England are likely to match the ECB's rate cut as well in June. Wage inflation is falling here too, though from a higher level in the US, and we have yet to see the full effects of this month's 10% rise in the minimum wage. That is the big uncertainty. Overall, I do think the market's pessimism on rate cuts is overdone. If I'm right, we're in for some positive surprises in the next few months, which would be a favourable background for financial markets. Until next week, goodbye.